Today, we're unpacking a fascinating and highly debated thesis. The core argument we're looking at is that Bitcoin isn't simply digital gold, but rather an engineered, technological upgrade to gold's historical role as a store of value. We're going to strip away all the hype and impartially map out this analysis, looking purely at the fundamental properties of both assets to understand exactly why this shift in perspective is happening. Okay, let's dive into this. We've grouped this source's 8 key arguments into 4 clear battlegrounds. We'll be exploring practical utility, trust and verification, true scarcity, and finally, the future of savings. Let's see how these 2 heavyweight assets actually compare.
Kicking things off with Battleground 1, practical utility.
Think about it. Gold is literally bound by the laws of physics. Moving serious wealth means moving massive physical weight. You need armored trucks, secure vaults, heavy security, the whole shebang. In contrast, Bitcoin operates on a purely digital network. $1 billion weighs exactly the same as $10. Nothing at all. Digital wealth can be moved instantly across borders without any of that physical burden.
So why does this matter in the real world? Well, consider a really profound example from a CNBC report during the Afghanistan crisis. Imagine trying to flee a sudden national collapse. Citizens trying to escape just couldn't carry their life savings in physical gold or cash without facing an extreme risk of confiscation or theft at checkpoints. But those who had stored their wealth in Bitcoin, they were able to cross borders with nothing but a memorized seed phrase, totally restoring their funds on the other side. In extreme situations, mobility literally equals survival. Now, what's really interesting about divisibility is how big of a hurdle it is for physical metals. You can't just shave off a piece of a gold coin to go buy a cup of coffee, right? Bitcoin is entirely different. A single Bitcoin is divisible down to 100 millionth of a unit. These tiny, tiny fractions are called satoshis. This basically means Bitcoin scales down to handle microtransactions in a way that physical metals simply can't.
But hey, divisibility only matters if you can actually transact quickly. Enter the Lightning Network. Think of it as a secondary layer built directly on top of the base Bitcoin network. It's kind of like a digital tab that settles up later. It allows users to send those tiny fractions instantly, globally, and for practically zero fees.
So when we talk about final settlement, basically when a transaction is officially locked in and irreversible, there's a massive gap. Finalizing a major physical gold trade involves ass years, expensive shipping, and slow settlement delays. It takes serious time and money. Conversely, using the Lightning Network allows 2 parties anywhere on Earth to achieve instant global settlement. The logistics of finalizing a trade are slashed from days or weeks down to mere milliseconds.
Moving right along to Battleground 2, trust and verification. Here's a question for you. How do you actually know your gold is real? Sounds simple, right? But unless you're planning on biting every coin that comes your way, this is actually one of gold's greatest hidden vulnerabilities. If someone hands you a gold bar, unless you happen to be a metallurgical expert, you have to rely heavily on pure trust. To put the danger of relying on trust into perspective, consider a fascinating and honestly alarming Reuters report. 400 kilograms. That is a massive amount of wealth. In a major international incident, 400 kilograms of what were supposed to be solid, authenticated gold bars were discovered to be nothing more than fake gold-plated copper. Even highly secure vaults get fooled because authenticating the center of a dense metal bar is just incredibly difficult.
And this brilliantly illustrates the core contrast in verification. Physical authentication of gold requires melting, ultrasound, drilling, or hiring expensive experts. You are always fighting physical deception. Bitcoin, however, relies entirely on cryptographic verification. No melting required. Any standard computer running a Bitcoin node instantly and mathematically validates every single transaction against the entire history of the network.
So, the source argues Bitcoin solves this authentication problem with 3 main pillars. Because it runs on cryptography rather than metallurgy, it's virtually impossible to counterfeit. It's instantly verifiable by anyone with a basic internet connection, completely removing the need for specialized experts. And finally, it all operates on a transparent public ledger, meaning the entire network agrees on who owns what at all times. Mathematical certainty essentially replaces blind physical trust.
Next up, Battleground 3, true scarcity.
Now, this comparison gets right to the very heart of the inflation debate. Gold's scarcity is entirely dependent on mysterious geological reserves. We literally do not know how much gold is left in the Earth's crust or down on the ocean floor. There are even companies actively researching how to mine gold from asteroids. That just highlights how unknown its ultimate scarcity really is. On the flip side, Bitcoin operates on a transparent, hard-coded supply. Its scarcity is completely visible right there in its open source code.
And data from the United States Geological Survey actually backs this up. While they track known gold reserves, they freely admit that the exact global supply remains a perpetual geological mystery. Whenever the price of gold goes up, mining becomes more profitable, so companies just deploy better technology to dig deeper and find more. This means gold inherently suffers from a perpetual, unpredictable inflation rate based entirely on human effort.
So the crucial point is how Bitcoin's code fundamentally changes the concept of supply. It has absolute mathematical scarcity, permanently capped at 21 million coins. Its supply issuance is pre-programmed, halving every 4 years regardless of how much computing power joins the network. And most importantly, because this policy is decentralized, it is impossible for any institution, central bank, or government to manipulate or inflate the supply.
Which brings us to our conclusion, the future of savings.
Let's move to and see how this builds a really comprehensive picture. When you score these properties side by side, from mobility and divisibility to verification and settlement, you see a stark contrast. It elegantly synthesizes the entire analysis, showing a clear shift from physical limitations over to digital efficiency.
And you know, this isn't just some internet debate anymore. According to the source, major financial institutions, Wall Street firms, and even traditional long-term gold investors are actively analyzing these exact fundamental properties. The objective data comparing physical limits versus digital efficiency is causing a massive rethink in how generational wealth is stored and secured.
So we'll leave you with this final provocative thought. As absolutely everything from our communication to our commerce becomes entirely digital, we have to ask ourselves, what properties truly define sound money for the next century? Is it the heavy, difficult-to-verify metal of the past, or the mathematically scarce, instantly verifiable digital network of the future? That is the ultimate monetary debate. Thank you so much for joining me to explore this explainer. Stay curious and keep learning.